morning, everyone, and welcome to the 117th episode of the Veritas Fact-Finding Series. And this morning, I'm joined by my special guest, Brian Harskamp. Good morning, Brian.
Good morning.
In each episode of the Fact-Finding Series, we go on the ground to speak to industry professionals in an unscripted, live video format to discover how we can make better investment decisions. In this series, and with everything we do, we believe the facts empower investors and that better information leads to better investment decisions. If you like what you're watching, give us a like, follow us at veritascorp.com. By way of background, my name is Anthony Scilipoti, and I'm the president and CEO of Veritas, which is an independent equity research firm based in Toronto, Canada. And I'm proud to say this year we're going to be celebrating 24 years being 100% employee-owned and operated. Quick disclaimer, this broadcast is not to be taken as investment advice, and participants or employees of the Veritas group of companies may own securities discussed in this broadcast. While we love all our guests, and Brian, of course, most of all, this session may contain forward-looking statements, investment opinions, and comments that we do not agree with at all. Now, let me tell you a little bit about Brian. Brian and I met actually at last year's real estate conference. He attended our conference, and for those of you keeping track, we're going to be having our next conference this year on October 3rd, again at the National Club. And he joins us. He's the managing partner of Schinkel Appraisals, and which is part of the Ellens and Associates group of companies. That was founded actually in 1959 as Schinkel Appraisals and is among the most trusted names in residential real estate appraisals in the Greater Hamilton area. He's relied on by lenders from across the country for a wide range of, and I like what he says, challenging assignments. He has his MBA from McMaster University and lives in Hamilton with his wife, his 3 sons, and 4 bikes. We're going to talk about the bikes because I count 5 and you only have 4 bikes, but I'm just saying. So Brian, we're excited to dig into this. We've had so many different experts speak to us, whether it's at our real estate conferences or at our on our podcast webinar series in various facets of the real estate market. And your angle and your experience is very interesting, given that you're coming at it not having grown up as an appraiser, but having come into it as someone who's done their MBA as an expert sort of in business, and now taking that expertise to run an appraisal firm. So why don't you take us through a bit of your background, why you do what you do, and then we're going to unpack sort of what the appraisal industry is like, things that you're seeing, and of course, things that you're concerned about. Thanks.
Yeah, absolutely, and thanks so much for having me here today. This is a wonderful treat. All of my loved ones are tired of hearing me talk about real estate, so it's nice to find a set of willing ears. So I spent 16 years in the charitable sector raising money, and I've got a business background. And the thing that I particularly enjoyed about that is when you raise money, you're mostly talking to business owners about their businesses. One of the things that I thought was fascinating about that particular world that's actually translated to the appraisal world is you have this unusual, I call it an indirect economic relationship, where you have someone who's making a charitable gift really on behalf of a benefit for someone else, which is really, really interesting. And so it means that the way that you build trust is through keeping promises in a long-term relationship. You don't have the ability for the person to rely on product quality that's instantly received, right? When I go out and I buy myself, a nice sandwich, I get to enjoy that sandwich immediately and have the benefit of that. And appraisal is very, very similar to that, where you have kind of often a number of different parties. You'll have a mortgage broker who's requesting the appraisal, a homeowner who is basically waiting in the wings to find out what black box number is going to appear out of nowhere in their minds. We'll talk about that. and then a lender. And each of these parties have their own sets of interests. And you're trying to balance a set of relationships where your client wants something different than the homeowner wants, that may be something that is in line with what the broker wants. but not always so tightly linked. But we'll get to that in a second. So even though I spent 16 years in the charitable sector, throughout that time, my wife and I were small-time real estate investors, which is probably true for everyone in Ontario these days. It's like the most popular byline on anyone's social media, I'd imagine. And we discovered a few things. First off, we like people, we care about people, and housing matters. So to provide kind of a stable place for someone to live mattered to us. Secondly, one of my favorite things to do is to tell stories with numbers. And there's something very fun about putting together housing deals. I particularly enjoyed that. And so we had our head thinking about physical space and the people around that for a long, long time. Within the charitable sector, I always kind of felt like I was in the wrong sport. And so you have a bit of an annual moving target where if you have the best year ever in charity, it's like, okay, your board says, okay, next year, now beat that. And because recurring revenue when it's individuals making donations isn't quite as clean, that's a lot less fun than it sounds. And so my business partner who runs our commercial division, so we have Ellens and Associates. They've been around since the 1980s, focuses on commercial real estate appraisals, so institutional, high density residential, industrial, and so on. My partner had acquired, was in the process of acquiring Schinkel Appraisals, which has, as you shared, been around since the 1950s. And so there was an opportunity for me to come on and to lead that team. And so my last week was actually of my prior job was the first week of lockdown, quite literally that exact week. And then when I was starting, and this is a fascinating place to begin, just in terms of the story of Canadian real estate. Everything was basically frozen. We sat in the office tower where our offices used to be, and everything was on hold. The phones weren't ringing. My partner said, "How do you feel about a business that's doing no business?" It was kind of a bit of a laugh, especially given what happened like 1 month later. So it has been we're coming up on 4 years of probably some of the most dramatic movements in Canadian real estate in terms of the up and downs, and in terms of some of the regulatory intervention that we're starting to see, that I've observed in a long, long time.
So why don't let's unpack that. What exactly are you starting to see that's different? You say you especially want to focus in on the last 4 years, and that's a good sort of segue into where we are. Clearly, we went from the market being pretty hot in the early 2020, and then all of a sudden COVID, and nothing happened. And there was an expectation. I mean, Mark, the smartest minds in the market were saying house prices were going to collapse. CMHC predicted 18% decline across Canada. And clearly, we all know the facts of what's happened since. And in fact, house prices continued there to march higher. So why don't you unpack that from what's happened on your side of the fence, which is specifically related to what appraisers do?
Yeah, absolutely. So it was interesting. We actually were in the process of disposing of a property right around that window. So we had skin in the game in a big way. And I remember, like you were saying, some of the best minds were saying, no, it's going to go down, down, down. And there was a friend of mine who's a developer up in Ottawa, and he was the one dissenting voice saying, nope, hold on to it. And you're going to see. He's like, there's pent up demand. We're seeing that there's increased job security and liquidity that's being put into the market, and this is going to be rocket fuel. And yeah, he was the one guy that had it right. So unfortunately, we did not listen to him. So that ended up costing us a bunch. But anyway, so we ended up seeing a combination of interest rates. We saw a lot of folks that were tired of being stuck in apartment buildings where they were waiting for elevators, having all of the amenities that they had bought either the unit in the building for, or the surrounding area being restricted to them. We were seeing work from home becoming the norm, and a lot of people expecting that to be a norm for a long, long time. And funny enough, again, this was our lived experience where the property we disposed of, we sold it to a couple from Toronto, two professionals. One was a lawyer, one was an accountant, that moved to Hamilton because they wanted the backyard. They wanted a little bit more space because they didn't know how long we would be stuck in our own houses. And so what was fascinating about this as well is the supply didn't respond well. And so we've seen, there was actually a fascinating event that was put on by the Hamilton Chamber of Commerce last year, where they were looking at intermunicipal migration. And you saw initially kind of radiating out of Toronto into the GTA, then into Burlington, then into Hamilton. And now we're starting to see population movement into Brantford, into London, into Niagara and things like that. And I'll park another thing we can dig into later is interesting because lender coverage in some of these communities has been spotted. We have a lot of lenders that wouldn't historically have lent in places like Fort Erie because either the housing stock wasn't such that they were interested in, so too very tricky to appraise, or they didn't think that the marketability of the property was such that they could recoup an investment if a lender was, or if a borrower was a bad bet. So for us, going back to that particular moment, appraisal at its best is hyper local and it's hyper attentive to market conditions. But it's also looking at the body of sales history, transaction history that have taken place and using that to determine what the value would be. And this is one of these moments in history where values were increasing at such a pace where we were looking at stuff that was, a sale that was like 2 weeks old, and you almost had to do a time adjustment for market conditions because otherwise the numbers didn't make sense, because you were seeing stuff that was listing far beyond, and you knew that was going to go above asking, and you were trying to reconcile that into an estimate of market value that was based on demonstrated market conditions. So yeah, it was wild for us. Our firm has built its reputation on being thorough, and so that means that we know the little pockets, that we take the time to research the comparables, that we take the time to call listing agents when things look funny, and in that particular market especially, it was wild to try to get a grasp on what was taking place. And yeah, please.
No. And so you're taking us back now to probably 2021, right? And
yeah, that's right.
Latter part of 2020 and into 2021. So, and I think what'll be interesting, and then we're gonna let's fast forward to where we are now. But there's a lot of misconceptions, let's call it, of how the appraisal industry works, right?
Yeah.
Everything from this to, don't worry, I'll just call my buddy. I'm sure it's, I see this appraisal. Well, that was just done by a buddy, I bet, who saw the property and gave the valuation of, whatever the buyer or a lender whoever commissioned the appraisal to get done. Maybe you can just walk us through some of the legal and sort of structural situation of the appraisal industry.
Yeah, absolutely. So within OSFI's financial regulations, for the federally regulated financial institutions, you have a number of different criteria for lender due diligence. So one, for example, is there's an allowance for the use of automated valuation models. And then there's another specifically that refers to third-party appraisals. And within that, then they specifically say that the appraisers are designated, licensed or certified, they meet the qualification standards. And a big thing that they note is that they should actually be independent from the mortgage acquisition, loan processing, and the loan decision process, so that there's this arm's length kind of experience. And I like to pretend that I'm all fancy and refer to the appraisal industry as kind of like the Senate of real estate. We're the chamber of sober second thought. And part of that comes down to we're looking at what I call a repeatable sale. So what we saw when everyone's hair was on fire was the stories often were, we've lost out on 20 bids. We don't care what it takes. We're going to get this property. And we would often look at these sorts of situations and say, you know, you might not be able to recreate the perfect storm that was this bidding process on this particular file. And this may or may not necessarily be representative of a market sale because of these particular conditions. And again, that's not just the appraiser kind of sucking on their thumb, but that's through research and due diligence with regards to the offer process and talking to the agents and things like that. The appraisal, so within Canada, there's two main bodies, and the most established and widely accepted is the Appraisal Institute of Canada. So you find within that two types of designations. So you can have an AAIC, which is Appraisal Institute, Accredited Appraisal Canadian Institute, or the CRA designation. The AACI focuses on well, they can basically do the full scope of practice. They can do commercial, industrial, high density residential, but they can also do single family homes and things like that. The CRA scope can do basically stuff that typically qualifies for residential lending. There's a couple of workarounds, so I'll talk about that in a second, but mostly you're dealing with homes up to 4 units. You're dealing with non-working farms. They're able to do assignments related to machinery valuation and things like that. That's something that some appraisers will specialize in. Our firm doesn't actually do that kind of work. But a CRA appraiser can also partner with an AACI, and they can both sign the report and broaden their scope as well. So our firm is most of our staff are AACI appraisers, so we have that broader scope. And then you have a training designation called a candidate appraiser. And so the Appraisal Institute of Canada has partnered with UBC, and so I'm probably going to butcher the acronym, but there's basically a postgraduate certificate in property valuation that that you go through. And so appraisers are expected to have an undergrad degree. They go through the postgraduate program. There's a work experience component, and then there's also a demonstration report component. So it's a stink load of work to become an appraiser. It's not a quick and easy process.
That's interesting. I think that, you know, clarifies. I think there's an underbelly of thought that this is not really that they're not deep scientists. Anyway, let's now look at sort of what you're seeing. You know, people on today's watching today are going to be up to speed. I mean, we're aware that mortgage rates have gone up huge. We know that now their mortgage renewals there's the big hit that's coming this year and next year. Prices have started to come off a little bit, but we're still holding on. Volumes have picked up a little bit. Why don't you tell us about what you're seeing from the appraisal standpoint? What's the pressure with the people that you mentioned, all the three parties that are involved, right? The buyer, the lender, the agent, the mortgage broker.
Yeah, absolutely. So right now, first, just in terms of the information I'm sharing, our market area is primarily anchored around the greater Hamilton area. Our commercial team goes a little further afield, but I'll speak a bit more specifically about residential. So we're kind of going up into Burlington, out to Brantford and into Niagara. And so the first thing, and we actually had a chance to live this vicariously with one of our staff, there is an eternal undying hope in Canadian real estate always going up and always being a big bet. And one of the things that we've started to see is because there is this expectation of multiple bank prime cuts over the course of this year, we started to see some interesting action in the first 2 months of this year where people were effectively trying to cheat the bank, as it were. We're gonna get in while the interest rates are high, but that rocket fuel hasn't been lit in the real estate market, so that everything is going to be going to the moon again. And so while interest rates are still putting pressure on people's capacity to bid up properties, we're gonna jump in there. So even just taking a look, so let's say from kind of like last September of last year, we saw kind of into the fall months pushing into December that prices were actually steadily declining by a couple of percent. Then January we saw an uptick. Actually, it was pretty material, kind of 2-3% in some, and so we'll say specifically for detached houses. And now we're seeing kind of even from that September point that detached houses in the greater Hamilton area are pushing kind of a 5% increase, which is fascinating. We're also seeing, and this has been widely covered and discussed. We're big fans around the office of Ron Butler. We call him Uncle Ron, and
we know
Uncle
Ron.
Ron. Yeah, it's great. And Uncle Ron was talking quite a bit about how stuff isn't appraising on the new construction side. And one of the things that we found quite interesting there was typically the line in the sand was when we saw that major decline in the market, which was 2022, kind of around kind of March, April. So things kind of peaked out last week of February, first week of March. And then they went on a bit of a downward slide after that. There was a little bit of a recovery, but not to the same degree. And so on detached housing, we found that anything that had a contract price that was kind of pre-April 2022, there were some risks around that. There was a pretty decent chance that they would be underwater. But what we found to be really, really interesting was that was pushing back further, even to 2021 for condo apartment stock. And part of that is I think that there was an investor class that started to go away. And so people, when they were buying for their own kind of occupancy, there was more creativity there in terms of financing. Like it's been well documented of, intergenerational wealth transfer. Mom and dad are gifting kids $100,000-$200,000 to make it work. But you're seeing, a different set of demands around people who are buying properties that were historically kind of investor stock. Some of the stuff that was in between those, so some more attached housing, so in particular freehold towns and stuff like that, it's seen some beneficial, that's probably a loaded word, some price increase since last fall, not quite to the same degree we're seeing in terms of some of the detached housing. And that's because I think there's a Canadian romance with a detached house, that's kind of like, you've arrived when. And I kind of joke with my lovely wife that I know I'll have arrived when I have a garage. Don't have a garage yet. I keep living downtown in these old houses and no garage for me, but that's probably for the best, because my wife also reminds me that I'm an emotional hoarder, so I don't need more space to keep things that she wants to throw away. So
yeah, exactly. And so so what you're saying, you said you're starting to see now there's an uptick in some of the pricing, right?
Yep.
Especially for detached. I love your point about the cheating the bank, because there's this hope that rates are going to come down.
That's right.
And I guess they didn't see this morning's GDP numbers.
Yeah,
but
that's
GDP is still doing well, and
yeah.
rates don't come down when GDP is doing well. That's typically the way things work. So as a result of this, how is that affecting appraisals? And you said, at the time when markets were rising sharply, you had to kind of guesstimate, where it was going to be, because 2 weeks or a month to the time of closing, the value could have changed. What's happening now where there's so much uncertainty?
And so I want to just correct one quick thing there. We're always looking at established market figures. We're not underwriters where we're able to say,
Sure,
we're assuming that 2 weeks later the market's going to look like this. We always have to react to the existing sales data that we're working with. But to go back to that, and actually I just lost the train of thought. Sorry, can you remind me of the
I was
question
referring
again?
to, so what's happening now that, you know, right now where there's so
Okay,
much more uncertainty
Yes.
about what prices are going to do, how are you dealing with that on an appraisal standpoint?
So because the growth is not so aggressive, from our perspective, it's not so difficult to look at the sales information that we're dealing with. So we're always looking at reported sales. They're not necessarily sales that have closed, but they're ones through the MLS system that there is a sale or a conditional sale with an APS that we've been provided with. So that's what we're using to base our information. But what we're finding is actually expectation management often on the homeowner side or on the mortgage broker side. And that comes from a few different places. So first, that can come from, I'll tell you a fascinating little story. That can come from a homeowner collecting various pieces of information and trying to make sense of their own reality. So we had a particular file that came across our desk. And the individual came to us and said, actually, their broker, they're working with a credit union, came to us and said, Dad, the homeowner thinks their property is worth $1.8 million. And say, okay, let's take a look and see what we're doing here. So I took a look, and we're not allowed to give an opinion of value from the armchair. We actually have our standards require us to go through a demonstrated level of rigor and report in the appraisal format itself. I gave the credit union rep a call and said, hey, listen, I was just taking a look at this community. So this is in Binbrook, which is a subdivision in a farmer's field. That's part of the greater city of Hamilton. And sorry, Binbrook, maybe that's a nice thing. Maybe people like being a subdivision in a farmer's field. That's great. And I said, listen, just so you know, the highest sale in that community in the last 6 months is 1.6, and that was for a custom home on like a 2-acre lot. So I'm not saying that this thing's not worth 1.8, but I'm saying that the odds are stacked against it, because it looks like it's a builder home, right? Which is flat on 3 sides, and you get fancy, but you don't necessarily get that far north of the market fancy when you're dealing with something like that. So I ended up chatting with the homeowner. I said, can you tell me a little bit about how you came to this? And so this was like a June, July 2023. So he said, well, here's my vantage point. He said, first off, I know that a house around the corner, which was smaller than mine, that was not as nice as mine, sold for 165. And he was right. It had sold for 165. It was smaller than his. It was not as nice as his house. He said, secondly, I get the same pamphlets that everyone in Ontario has been getting for the past 4 years that talks about market trends. And this particular pamphlet from my local realtor is saying that the market has increased year over year, 1%, 2%, 3%, somewhere in that neighborhood. And actually, that was also factually correct. That was roughly what the market had done year over year. But there were 2 pieces of information that led to this person coming to a $1.8 million valuation when it was worth quite a bit less than that, in our opinion. The first was the market had, the sale that he was looking at had sold at the very peak. It was February-ish 2022. And from that particular time to the moment of time, the market was down, I think it was close to 20%. So his frame of reference was off. The second thing is we happen to know that property, and that was one where people had gotten very, very excited. We knew that property had actually appraised for 200 grand under the purchase price. So the challenge is you have well-intentioned people that are trying to stitch together a whole bunch of pieces of market information into a narrative that makes sense for themselves, and then they're trying to use that. The second thing that's happened is we used to kind of joke that we were the Oprah of real estate, where it's like everyone in the auditorium, look under your chairs. You think your house is worth 500,000? It's worth $1 million. And everyone's screaming and happy and excited. And it meant that people were also, the odds, what was at stake was much less. People were refinancing their homes to put in pools. And so it's okay, you know what, I can get a smaller pool because the appraisal came in light. Sure. That's fine. what has happened now is I was chatting with one of our broker partners who we do a lot of work with, and he said, Brian, it used to be, even in the people who are in trouble, it was debt consolidation. Now it's mortgage arrears. So the stakes are higher too. So you have a situation where people are having a hard time because the market information has moved a lot to put together the story of their house. Secondly, everyone's blood pressure is through the roof because the stakes are way higher. I noticed this week that Daniel Kahneman passed away, and one of the things that he was particularly known for, kind of at the popular level, was that you had this interesting kind of dynamic psychologically where people were, how did he put it again? He says the loss of $100 hurts about twice as much as the pleasure of gaining $100.
Yes.
So we're also in that particular situation here where you have people who came into the market, who knows what particular moment, who may have refinanced to put in a pool, may have been floating, may have used a private or some other kind of alternative lender, and are now feeling the pressure. And now we're having to deal with a situation where there's a lot of pain. So that's one of the things that's really changed in the market for us right now is there's a lot of opinions of market value. Some of them are tied to tools like Purview, which is like a kind of an AVM tool that looks at sales that a lot of mortgage brokers use. And the values that come out of Purview can be all over the map. Sometimes it's celebration. We had one where a property was worth close to 2 million. Purview was saying it's worth 1 million. And we've seen kind of the opposite of that as well. And that's because it's, to my knowledge, using kind of maybe a less granular approach to the specific property.
Got it. And so as a result of this, you're obviously making some people right now very unhappy. They think where that appraisal's coming in, hey, I'm going to, I need to refinance my house, and that appraisal's coming in at perhaps less than the current mortgage value. Are you seeing that? It could be coming in at definitely less than they believe the house is worth. And so how are these homeowners coping with this? Because we're not seeing, the flood of houses on the street being listings. I mean, listings are up. It's starting to tick up, that's for sure. But prices haven't collapsed by any means.
No, they haven't. And so a lot of it depends on who the mortgage broker is. And so a mortgage broker may or may not have advised their client on what's happening. They may have opinions of their own, like it depends on the source of that value. So that can be one part of it. One of the things that's a little bit tricky in our industry as well is I was talking about that dynamic between the mortgage broker, the applicant, and the lender, and that there's this requirement for independence of the appraiser. And one of the things that we often talk about among our staff is the nature of that client relationship is we're actually bound by our standards to only report to our client. And our client is ultimately the lender. And the lender, there's even some lenders that actually, they have, there's a couple of different things that we're required to comment on in the report. So one of them, we're asked to comment if there's undue influence from the homeowner trying to get the value up. And so that there's a disclosure there. And on the flip side, and this actually, we can have a whole other conversation on fraud, the confirmation that the homeowner actually is aware that the appraisals for financing purposes and that a mortgage is potentially being put on the property. And we confirm that in the report as well. But what happens then is the applicant, the homeowner, is not entitled to a copy of the report. And so more often than not, the broker will get a draft copy. There's another party that gets invited into this stew of people called appraisal management companies. And we can talk about that. But in those sorts of situations, the mortgage broker won't even necessarily get a draft copy of the report. And so a homeowner is being advised, and sometimes not even being advised, because it's up to the client's discretion what the value is, and they're given no rationale behind that. And on the appraiser side, like we always tell our broker partners, like, listen, like we own homes, we've gone through the mortgage process. No one here has an axe to grind. Like I don't have this kind of masochistic kind of need to go tell people their houses are worth more than they're actually worth. Like that's, I don't get any satisfaction. And I say, even as like from a business owner's perspective, anytime we have a value that's coming in below expectation, that's way more work for us, way more work, because we're now having to justify the report at a different level. We're often asked to reconsider other sales, which we happily do. Anytime we're presented with information, we'll always look at that information, absolutely. And there's reputational risk. Again, because we have this client relationship, our Google reviews are a lot of homeowners who are just pissed off.
And the interesting thing about that, it's not the homeowner that's your client. You made the point right at the outset that it's the lender that's your client. And the lender obviously has an objective to have the value as low as possible, because they want to make sure that they're covered, right?
Yeah, and that can absolutely be that, like, they're trying to play that balance of protecting their interests, and we're part of that underwriting process and their risk management process. And they rely on the report and ultimately can sue us if there are issues with the report and they encounter loss. But the other thing that we've actually found to be a bit of a mitigating factor, and this is how we built the reputation of our firm, is there's a lot of appraisal work that's done for non-mortgage financing purposes. And so our firm actually has a very strong reputation of doing a huge amount of family law. And when you're dividing marital assets and you need to put a value on a home, if you want to talk about places where the emotions are charged, that's absolutely one of them. And in those scenarios, I always like to say, listen, we're fair. And we're fair on both sides. And that's how you build a family law practice, is you're not punitively low and you're not pie in the sky high. You're having a report that both parties are going to look at, that legal counsel is going to look at, and that potentially a judge is going to look at and say, yeah, no, that's a reasonable, like, again, they're not appraisers, but they have the ability to bring in competing opinions. And if you're out to lunch and you're sloppy, you don't do that kind of work, people don't come back.
Understood. So and you get the bad reputation in the courts, and then your basically your appraisal becomes worth nothing.
Yeah.
Talk to us then. Let's try to see if we can pull all this information together with what you're seeing. So, what are you worried about? Clearly, you're getting more pushback now. Homeowners are not happy with you. I'm sure when one of your guys goes to visit, they're given bottles of wine and let me give you coffee and what else can I get you, sir or ma'am, right? And none of that actually helps, but we all think it's better to be friendly than not. And so what do you see happening? I want to tell everybody on the call that actually we spoke a couple months ago, early in the year, when we were planning this, and your view at the time was that you thought spring was going to actually have a little bit of a lift, because there's a lot of pent up demand, and I got to say, you were right. That's sort of what we're starting to see. We're starting to see a bit of levitation, more transactions, prices holding on, and in some areas actually rising. So let's, from your vantage point, what are you seeing going forward?
Yeah. So maybe we'll talk about owner occupied first. What we're seeing, and going to that mortgage broker conversation where people are in arrears and are trying to save stuff. Like, I just want to be clear that the files that come out of our shop are not universally below the broker's estimate of market value. Again, there's fair, and a lot of great brokers out there have a pretty accurate picture of what's happening out there. But what we're finding is people are doing what it takes to keep their homes. Another favorite, and I think he just hit like 500 podcasts, which is impressive, is Doug Hoy's The Debt Free in 30. But again, my wife looks at me like I have the worst hobbies in the world, because it's another fascinating kind of zeitgeist for our particular industry. And he says, if you don't solve for cash flow, you're just kicking the problem down the road. A lot of people are kicking the problem down the road. We're seeing second position, third position on a regular basis. And a lot of these we're seeing are on that 1 year renewal, where they're going back and trying to buy themselves more time, and with the hopes that the market will eventually catch up to a particular point where they might be able to get lower cost financing. So the first thing that we're seeing is people are often by their fingernails doing what they can to hold on. our power of sale work has gone up probably 6 to 8 times compared to last fiscal, but it's still a pretty inconsequential part of our business. And we're, when you and I last chatted, I think you were the one that made the comment that if people have their jobs, that's going to be a material component on what happens on the power of sale side. And we're seeing that. We're seeing that, we saw the big tech layoffs and things like that. We're now starting to see some automotive manufacturing layoffs, but that I have not necessarily seen that materially pushed through on our end. Maybe that's coming still, but that's your area of expertise, not mine. So I won't wade too deeply into those waters. But that it seems as though that capacity to pay to a point remains. On the institutional side, or we'll say actually not the institutional, the investor side, what we're seeing is more creative rent arrangements. So we had an appraiser go into a property, and it was a triplex that had been converted into a rooming house. And so every door is individually keyed. You might have a single master lease to satisfy, but a lot of private money, they don't care if it's a legal unit. They want to know what market rents unencumbered by the law are. I should be careful there as well. Like I don't think they're looking to do something unlawful, but they're saying right now there's a rental shortage, and we're in a situation where people are getting a house or a room anywhere they can, and there's often a lineup for these sorts of places. And so they're saying, okay, if someone's going to rent a bedroom or someone's going to rent a unit, what's it worth? We have restrictions in terms of what we can give a market rent opinion on, because we're bound for it to be a legal unit by our standards. But with inclusive zoning and things like that, that's more and more kind of coming down to actually fire code, building code kind of restrictions than it is to zoning restrictions. And so you're seeing more creative rental arrangements and a lot more of that as a way to kind of hit your borrowing costs there.
And then what about condos?
Those are tricky, right? Like it's especially because a lot of this stuff is like 1-bedroom kind of units, and it's hard to squeeze more out of those sorts of things. And so what we're seeing on that sort of stuff is more kind of bundled loans, where people will have a couple of different condominium 1-bedroom units, and they'll be tying that into kind of like a single family home mortgage as well. So there'll be multiple properties that are being covered, and they're trying again with this hope that when the market recovers, use my air quotes there, with that eternal optimism, then I can unload these properties. The other thing that we're seeing, which is interesting, and a year ago this didn't exist, is people are retaining us to do an appraisal so that they can negotiate with their builder. And we're also being retained on the builder side, where you're seeing some of these where the builder is also doing a VTB. So we're doing a lot of that kind of work now as well, where they're trying to help bridge the gap so that people can close. So yeah, you're underwater by $150,000, $200,000, but now at least for a set period of time, you owe that to us. And that's kind of interesting as well. So what makes me worried is I think those rate cuts, per your comment just a few minutes ago, even, I think they're further out than everyone wants them to be. Like, I think they may be they're going to come, but I think some of the earliest kind of hopefuls were saying, okay, Q1, at 24. Well, sorry guys. Now we're starting to see June. Okay, we're going to see rate cuts in June. Okay, maybe. Again, that's way above my pay grade. I'm not going to do Uncle Ron's Tiff Macklin voice on the podcast here, but we're seeing. I always tell my staff that the one thing that we're seeing is the things that affect rate decisions they're complex. There's no single right answer, it seems, and all it takes is a jobs report or a offhand comment. Well, I'm sure they're not offhand, but a comment in a central bank's kind of announcement to hold rates, and you see that 5-year bond rate just do whatever it wants to do. Like it's it's all over the place, and it's quickly impacted. So yeah, so I think there's a lot of folks that are likely on borrowed time. Another thing that's probably worth noting is we don't see any of the rate commitments that are going. We don't see any of the borrowers, their fundamentals. We're given an applicant's name and a property, and that's
Right.
usually, and some of the time, and not always, an estimate of market value. So we find that a lot of the alternative lenders, they don't actually provide an estimate of market value because they want it to be as independent as possible. And so we don't know how in hoc an individual is, how last chance it is, unless the person tells us, hey, by the way, this is pre-power sale. So just so you know, we're trying to save something here.
If anybody has a question, please put your hand, hover over the question and answer, and please type in your question, and I'll make sure that Brian answers it. In the interim, I just put in the I launched our poll so that you can tell us what a great job Brian did, and help us out with other ideas. Brian, are you getting situations, and I think this is just as I listen to you, where the lender is pushing back on you and saying, I go back to the drawing board, there's no way, that's not it?
So we don't know. No, that almost never happens on our end.
Okay.
That's usually when a broker gets a draft copy that we're seeing that on that side.
It's more the broker or the owner that's most, the lender is just sort of, it's a computer essentially. The bank says they go and do an appraisal, you go do it, it comes back, they say, yep, okay, I get it.
Yeah, and it's interesting too. So I should be a little bit careful here, because I've not worked at a lending institution before, so I'm not intimately expert on
Sure.
on their policies and procedures. But we had one lender that was based out in BC, and this particular person was sharing that they were working with an appraiser, and they had a value that they thought, no, this is totally out to lunch. And he said,
Right.
we've fulfilled our requirement to actually have this appraisal process taken, but we know this market as well, and so we adjust kind of our lending thresholds kind of based on our own expectation there, and then we have this appraiser. We can effectively sue the appraiser if we need to. So which is always a little bit fun. That's not exactly like,
are you seeing
again,
more? Are you seeing more private lending coming into the market?
So I should note that our firm, we deal very heavily with that segment of the market. So, and part of that is a lot of VA lending is done via these centralized appraisal management companies. So appraisal as a field can be very, very fragmented. The Appraisal Institute of Canada said that the typical firm on average has only 4 appraisers. So we're a good size bigger than that. But what that has meant is the appraisal management companies basically maintain lists of approved appraisers. So appraisers, more often than not, are either on a specific lender's approved list, or there's a few other lenders. So like community trust, a lot of people use community trusts list because they've had a history of being fussy. And so we're on the vast majority of those lender lists. But what we do not do a ton of lending work, because that goes through the appraisal management companies, and those are typically low fee, low risk, low research, appropriate research. But
so is that more done drive by, or is it computer?
So they can be. So you've got 3 primary formats on the residential side. Commercial has a different set of reports. So you have the full report, and that can also include a market rent schedule. You have a drive-by. So that's typically when you can't get access to the interior of a home, or where it might be a lender saying, hey, we've used an AVM, but we want a quick check on this. And then there's a desktop. And the drive-by and the desktop, they provide not a specific value, but actually a range of value. And often they're described as, it's kind of like a neighborhood check. So going back to that 1.8 million and a place where the 1.6 is the highest sale, they're wanting to say, realistically, where does this house fall within this particular range based on the information you have available?
So if I understand correctly, it's more in the alternative lenders that they're using more firms like yourself, accredited lender organizations. You have working with you numerous appraisers who are accredited, and then they would do more of the sort of detailed, actually going to the location and doing the appraisal.
I would say there's a bit more fragmentation on the private lender side. So it's not unusual. The private alternatives will have more intimacy with their appraiser network. Whereas with the appraisal management companies, what they offer the big banks is someone to scrape information, to do aggregate appraisal evaluation, and to also put pressure on fees, which can be beneficial given the volumes that they're looking at. So we could absolutely enter into that space. We've found that the marketplace puts a premium on our experience, much more kind of on that alternative lending and some of the non-mortgage work, because we are careful, we are fussy, we do take the time to actually do the research very carefully, and not implying any of my colleagues and other firms aren't doing that, but you have more time based on the fee structure to do that on the non-AMC side of things.
Okay. So as I'd like to ask all our guests, because of course it's my favorite meal, your favorite breakfast restaurant and your favorite breakfast meal.
So favorite breakfast restaurant, I've got my wife and I, we like to say we when it comes to food, we play the range. So we like fast food and we like fine dining. And so I'll give you, it's not quite fine dining, but let's select in Toronto. I like my sandwiches to have a hat. So the croque madame is just fantastic. Love the Gruyere, love the bechamel. Oh, it's a good life there. But then why don't we keep it sandwich consistent? And the McDonald's sausage McMuffin. I have like this, it's now family folklore where somewhere in northwestern Washington state, I had a sausage McMuffin that was made with a rosemary, the English muffin. And I don't know if my memory is playing tricks on me, but boy, was that good. Got to trace that down again.
And last but not least, your favorite book that you'd like to recommend.
Yeah, so it's interesting. We talked earlier briefly about bikes, and I listen to podcasts when I'm on the bike, and I was listening to Arthur Brooks talking about happiness, and he said that happiness is often the kind of the confluence of pleasure, people, and memory. And for me, the book that hits those marks is actually The Hobbit. You could actually say The Hobbit's also interesting from a real estate point of view, right? Like the Hobbits have obviously, they've developed the green belt, and so they've got these boroughs. Then you go and you've got this historic kind of housing in Rivendell, and then you can make your way to the dwarves. You got a lot of different housing stock there, and a lot of different density models. But yeah, we've read those books now with my boys, and they're delightfully timeless.
Love it. Brian, thank you very much. I'm sure we'll speak to you at some point before our real estate conference, if not at the conference. And thanks for your time and your expertise.
Thanks for having me. This was a delight. Appreciate it.
Thank you.